President Cyril Ramaphosa says the decrease in GDP reflects the severe impact of the global coronavirus pandemic on the economy and should spur all South Africans to do all they can to rebuild the economy. He says that while 16.4% contraction in the second quarter or 51% on the annualized basis represents an anomaly due to the lockdown imposed at the end of March, these figures nevertheless reinforce the importance of enabling a strong rebound in subsequent quarters.
Ramaphosa has also pointed out that South Africa has not been spared the economic disruption facing the world as a result of the COVID-19 pandemic. Well, it's now or never for government and business to kickstart the economy. Next month, the Finance Minister, Tito Mboweni, has to present his medium-term budget policy statement, and it will need to contain some urgent remedies for a country that is spending more than it's earning.
For more on this, we're joined by Stellenbosch University Business Development Economist, Dr. Nthabiseng Moleko, and economist Mike Schussler.
Dr. Moleko, good evening to you. Let's start with you. Firstly, these figures were broadly in line with expectations, but they really show the damage done to our economy by COVID-19 and the lockdown.
Absolutely. Thanks so much for having me, and good afternoon to the listeners. We did expect a contraction of all subsectors based on non-essential services versus essential services. The lack of global trade, the lockdown globally would lead to a commodity slump, and expectedly household consumption and demand of household goods would contract based on also lower and depressed household income levels, but also on the contraction of wage earnings during the COVID slump. So you're seeing the supply side contractions, you're seeing the global slowdown, you're seeing a contraction of all subsectors in the main, up to 76% for some, and only agriculture coming out positive. This is telling us that on the back of pre-COVID negative numbers, pre-COVID also gloom in the sense that we had significant rating downgrades and also the negative recession we already had prior to COVID, and this is just the continuation. What we need to do is stop the drop, and what we need to do is have an urgent economic consensus and intervention so that we stimulate our economy, so that we bring the sectors back up and we boost industrialization so that we can absorb the more than 10 million unemployed South Africans.
Mike Schussler, what many South Africans are going to be asking themselves tonight is, what exactly do these numbers mean for me? How am I going to be affected by the significant contraction of GDP?
Well, very simply put, people are going to struggle more to get jobs. We've probably lost a lot of jobs. We believe that the unemployment rate will go from about 30.1% that it was in the first quarter of this year to about 40% by the first quarter of next year. We haven't got the unemployment numbers yet from Stats South Africa, but the fact of the matter is unemployment is a lagging indicator, and we expect more South Africans to lose their jobs. We already know that roughly about 10% of the formal sector has not had an income for quite a while, and we expect that to grow. We know that the UIF has been paying out, but that's stopping, and we'll see the damage of that in the next couple of months. So we are severely contracting. Job opportunities are rare. Our income is being pressured. The only sector that also didn't decline over a year was the government sector. So government has become very big, much bigger. That means we cannot afford government, or we're going to have to tax the rest of the sectors more. It's going to take us years to make up this loss, literally probably the best part of half a decade. And to get back into sort of per capita terms, probably the best part of more than a decade, probably around 15 years or so. So we are looking at a very sharp contraction. The average South African is poorer today than they've been at any time since 2002. The economy is smaller than it was in 2010. It is a very severe situation that we have on our hands at the moment.
Dr. Moleko, you heard the severe situation being painted by Mike Schussler there, and the fact of the matter is that even before COVID-19 we'd sort of been heading in the wrong direction for quite some time. This is the fourth quarter in a row of economic contraction. You will know the endless conversations we've had about deep reforms to our economy. Is there any scope for them actually to be implemented? Do you see some of them coming through now?
We need the state at this point in time to really drive the agenda of a new growth path. When I say a new growth path, I mean a different growth path. What we have seen over the last 25 years, if you look at per capita GDP, we are where we were in 1994. So there was an increase based on Asgisa, GIPSA, and what was done in the early 90s and early mid-2000s. We've regressed in the last decade because of the economic policies that we have implemented. I think that what we really need to do is to have a consensus on the planning of the state to drive conducive, inclusive, and redistributive growth path. What do I mean by that? The large majority of South Africans are not employed despite us having an increasing GDP in the mid-2000s. This points to the type of growth that we have had. The massive contraction that we have seen overall in our GDP is much larger than most of our BRICS or emerging market economies. You'll see that China on the main has had a positive GDP despite being the core center of COVID. We, on the other hand, have more than double the contraction of most African, on an annualized basis, of most African economies. And you need to ask yourself, why is that? And that is on the main because of the contribution of our secondary sector and our primary sector, and we are largely services-driven economy, highly financialized, but the financial sector is not necessarily reinvesting all of the cash reserves into your productive sectors of the economy. So as a result, in the main, you're seeing your mining, manufacturing, contracting year on year quite significantly. You're seeing your construction and your utilities also contracting, even the last quarter, by up to 36% and 75%. These are significant contractions. We cannot have a growth path that is driven by debt-led consumption or debt-underpinned consumption. Particularly now with a decline in household incomes, particularly now with a decline in jobs, we're going to see less incomes. And if you don't have industry growing, you don't have a productive growth that is being driven in the main by economic policies, you're not going to see a change in the growth path. So we need to, one, labor absorptive industries have to be in the main on the forefront of our economic growth strategy. Two, we need an energy base to have sustainable economic growth. The Eskom crisis needs to be resolved, and it needs to be maintained, the cost model, the efficiencies, and I think you'll discuss that later. But there can be no growth if there is no sustainable and efficient energy that we have for the country. And I think the third thing is we have to look at increasing public investment while we are restructuring towards growth. The big question is the debt to GDP levels that everyone's mouth is talking about. However, if you don't look at growth as the key driver of the debt to GDP ratio worsening, you're not dealing with the main problem, which is that the South African economy is not growing. If you have a growing economy, your debt to GDP ratios are dealt with adequately. So we need to look at how do we grow our economy, how do we employ South Africans, how do we mitigate inequality, which is the worst in the world, how do we make sure that we redistribute the gains to the masses of our SMMEs on the ground, and in the main black-owned SMMEs, which are not in the economy and in the mainstream. Even if you look at the fiscal stimulus, they are not in the main the majority beneficiaries of the existing loan guarantee scheme.
Sure. Mike, Dr. Moleko has spoken about this new growth path effectively that the country would need. But of course, there are present challenges and present spending needs. So what does Tito Mboweni need to do in his midterm budget to show that government is being responsive to the state of the economy as it is right now?
Well, he's really between a rock and a hard place. No wonder he's sharing photos of him growing marijuana on Twitter. The fact of the matter is we have a very severe problem that the private sector has actually contracted with over 20% over the last year. If one leaves out the financial sector, one's looking at about 27% contraction in the private sector in South Africa. The economy, therefore, cannot provide much more money to the government sector because the private sector generates that wealth. And we are going to see a very severe problem because he's not going to have the tax income. Borrowing is going to be very constrained, and we are at a crossroads. So we are going to have to cut back on government services. I don't know which ones he has, but it's going to be very difficult for government to have an investment-led growth if government itself over the last decade has not been investing in the country. The private sector has been the major investment in the country and has also seen most of the growth of investment in the country, whereas the government has not. The government has decreased its investment, and as a percentage of GDP, government is less than 3% of our fixed investment. So I don't think he's going to get the money to invest because there just isn't. And he's going to have to make some very hard choices within the next few months. I would suggest by the February budget, we are going to have to see an outcome, what he's going to do with the civil service. Our civil service is one of the highest in terms of what we pay them per GDP. We've also got the least amount of adults of any big economy employed, which is only about 40%. That's your problem because your inequality starts with people not having an income. So our inequality problem is we don't have enough people working. And that is a major problem that South Africa has. And I think he's going to not be able to deliver as much as people hope. It's a very, very dire situation at the moment because, quite frankly, government in this economy where they actually grew over a year ago, whilst the private sector shrank with 20%, and if one leaves out the finance sector, which also relies on the real economy, we're looking at a very, very dire situation. You cannot tax something that's shrinking that much, so you have to then unfortunately cut the spending of the other one. And our borrowing requirement is probably going to be well over 16% of GDP now, not the sort of 14% that they think. So we're looking at a probably 17, 18% budget deficit. We're probably not going to be able to get the loans within the next year. I think it's going to become much, much more difficult. So we are at a crossroads, and within, I would say, a year, we're going to have to make choices about what to cut in the government budget. Will we cut universities? Will we cut schools? Will we cut health? That I don't know, but we will have to start cutting.
Those are incredibly tough choices, Mark Schussler, and I suppose we'll have to wait and see. But if I'm hearing you correctly, at the end of the day, South Africans are going to be paying a heavy price for the state of the economy currently. Dr. Nthabiseng Moleko there from Stellenbosch University's Business School, and of course, economist Mark Schussler. Let me thank you both for your time on The Pulse tonight.